A few years ago, I met with a couple who had a net worth that was over $100 million. They were interested in whole life insurance. What I'm going to cover in this video is why they were interested and then their process of purchasing that whole life insurance policy. So firstly, why they were interested in whole life insurance. They didn't really care about the life insurance, and they made that clear during the first meeting. They were interested because of the cash value. See, they had a lot of cash just sitting in the bank. They had money in the market. Money in the bank was meant to be safe money, so they're looking for alternatives to place that money. Life insurance came up in their research. They had met with several agents, and when we first connected, the husband made a comment. He said, "I've looked at whole life insurance. When people show me the policy, I say, why would I do this?" Because he was shown policies where he was paying a premium year in and year out, and it took him 10 years to get his money back. He's like, I own a business. Why on earth would I put it here and wait 10 years before I see any type of return when I could just keep on putting it in my business? It didn't make sense to him. So he didn't get that policy. I would not get it either. So what we did was looked at a policy where he had rich cash value up front. So why he was interested in a whole life insurance policy and moved forward with one is because we were able to show him how he could put the same amount of money in that he was looking at before, but immediately see cash value up front. He actually had more than 95% of what he paid into the policy available in first year cash value. Why he was interested was because the cash value was a safe place to grow his money. He could access it any time like a line of credit, and then it also grew tax-free. Being in the highest tax bracket, the tax benefit was very appealing to him. Now, the second thing that I want to hit on was how he qualified the agent that he was working with, which in this case was me. So after we had our first meeting, everything went fantastic. He's like, okay, I like this. We want to move forward. But a couple days later, I get a text message from him that says, Steve, I liked everything we went over. Before we move forward, I would like you to meet our trust attorney. She is one of the 3 people that I trust. The other is my wife. And then the third is himself, obviously. So I'm like, sure, no problem. I'll meet. I mean, I've met with attorneys before. So we get on a Zoom call, and this attorney was the sharpest attorney I had ever met when it comes to tax planning, estate planning, and cash value life insurance. Her name's Elizabeth, by the way. You can check out some podcasts of her on our channel. But the first time Elizabeth and I met, she was coming at me with these questions. I feel like she was trying to chop my head off, asking me about the commissions, actual policy performance, the guaranteed rate, the net versus the gross. It was apparent she knew her stuff. So the meeting went very, very well. I'm like, no, I'm your friend. I'm not trying to take advantage of them and get a high commission or anything like that. And when we went through the data, things calmed down. She's like, okay, I see what you're trying to do. This worked out. We had a meeting later, and she's like, you passed the test, by the way. I'm like, all right. Didn't know I was being tested, but I appreciate you letting me know. But my point to that story is how they qualified me in this case, and how they qualify a lot of people that they work with, is they have an expert come in that's very, very good at what they do. See, Elizabeth, with her background and experience, she understands cash value life insurance because she has helped some insurance companies develop BOLI products. She works with actuaries. She's got a lot of knowledge in that field, and she knows what questions to ask and knows how to ask them. And then when someone answers that question, she can tell if they're honest or if they're just making it up. She can really read people well. So they used an expert to help qualify an agent before they would trust that agent with a large amount of money. This is something that I've seen to be very consistent with wealthy individuals and also corporations. So one of our largest clients is a bank, and before the bank proceeded with cash value life insurance, their board had to approve it. I had to meet with the CEO, another executive who used to be an examiner, very detail-oriented, and then a high-level executive who was just firing aggressive questions at me. But my point is, there's multiple advisors that help make this decision. So step 2 for this $100 million couple is they qualified the agent by bringing in an expert that helped make sure everything set up was in their best interest. Number 3, the life insurance company they picked. So we looked at several life insurance companies. I'll always recommend the 4 major mutuals: Mass Mutual, Guardian, New York Life, and Northwestern Mutual, because they provide proof of performance. And this was very important when we had that meeting with Elizabeth and going over the proof, not just saying it, but showing here's proof of performance, that they don't just promise great looking numbers on an illustration and under-deliver. Like, no. We've got data that shows they actually deliver. We did look at a smaller life insurance company. The husband had actually asked about Penn Mutual because their numbers look great on paper, but we haven't received any proof from them over the years. Even when I've met with their high-level actuaries, we haven't gotten any proof. So we dismissed them, focused on the major mutuals, and they ultimately selected Guardian Life Insurance Company of America. And the big reason they picked Guardian was because of their PUA flexibility, which means how they could actually pay money into the product, which leads to point number 4, what product they chose and how we set it up. So they chose a product that is referred to as an executive strategies whole life insurance policy. This policy is reserved for higher net worth individuals and then also corporations. It's kind of in the name of the product, executive strategies. Sounds fancy, because it is. It has a $100,000 minimum requirement, meaning I have to pay a minimum premium of $100,000 per year. Now, this couple that at the time was worth about $100 million was looking to put in $1 million per year. And that's what they started with too. So of that $1 million deposit, how we set it up, their minimum premium was $100,000. Then everything above that $100,000 premium payment all went toward what is called your paid up additions rider, or PUA rider, which maximizes the cash value. So they're committed to $100K per year and have the ability to add up to $1 million per year. So that was a big reason why they went with Guardian, because of that flexibility. How his policy works specifically is that he is billed for about $100K per year, and then he can add extra money at his discretion. He liked that flexibility, just knowing that he wasn't on the hook to have to write a check for $1 million every year, even though that was his plan at the time. So we set it up where he's committed to the minimum, can add more at discretion, and then that specific product does give him a lot of cash value up front. He actually had more than 95% of his $1 million payment in first year cash value, and the break-even point, when the cash value was positive, meaning it exceeded his total payments, didn't take 10 years, like his original objection. It was about 3 years. He actually just surpassed that as we review his policy every year. And then point number 5. This does not apply to them, but this really just applies to the overall process, how to copy them. So whenever you hear of a $100 million couple getting whole life insurance, but not for the life insurance, for the cash value, do you want to learn what they did so you can copy that process? I do. That applies to business and everything. So what I would do to copy their process is as follows. I'll simplify this as much as I can. Number 1, try to have someone that can help qualify the agent that you're working with. This doesn't have to be someone that sits in on the meetings with you. It's just, don't make an emotional decision to say, I'm signing right now. After you meet with an agent, take that policy or those numbers that you've been presented to someone that you trust. Maybe they have a finance background, maybe they don't, but they're just really good with numbers and they've always given you good advice. They can help ask questions that you may not have thought to have asked during your meeting with that agent. Because remember, it's your money going into a policy. Where people have buyer's remorse is when they put a lot of money into a policy and then find out after they started it wasn't that great, that they could have had more cash value, especially up front. So by qualifying that agent, which really just means asking someone else for help and having them review the policy and saying, hey, did you ask these questions about why is it so low in the first year? Why does it take so long to get your money back? What's the loan interest rate? If you take loans and don't pay it back, what happens? Someone that can help to ask those questions you don't think of, that can go such a long way. I would always recommend that. Number 2, company selection. We talked about the proof. So why I like those 4 major mutuals, Mass Mutual, Guardian, New York Life, and Northwestern Mutual, is simply because I've seen consistent proof. meaning people have had policies. I measure the internal rate of return, which is a fancy way of saying the average return over a 10 or 20-year period, and it's doing what it's supposed to. It's higher than 4%. I don't really like using smaller companies at this point because there's always a game. I haven't seen any proof. I always get responses, well, it doesn't matter if the illustration showed this back then, it should produce this same return. I'm like, okay, I've heard this so many times from so many different life insurance companies that it should perform, that they do have policies that have performed, but they can't show it. I am not going to risk someone else's money and have them hope that it works out, and then it doesn't. And then when I use smaller companies, they usually pay a lot more in commissions. That just creates a situation where the client loses, but I win. It's like, no, we've got to have that proof of performance before we recommend someone move forward. So second step, company selection. I'd always look at the 4 major mutuals. And then step 3 is the product choice and product design. So the product we mentioned for that couple was exclusive to higher net worth individuals, but you can mimic that with traditional whole life insurance products. Maybe instead of breaking even year 3, it's going to break even closer to year 3.5 or year 4. And instead of 95% cash value in the first year, it might be 88 to 90% cash value in the first year. So you can mimic them very, very closely. And to do that, the policy really just needs to be designed with a minimum insurance premium, and then we're stuffing everything else into that PUA rider, which stuffs your cash value. So those are the steps that I would take. I hope this helps. Thanks so much for watching.